Welcome to G Fun Facts Online. Today, we're diving into the hidden world of the entities that hold the economic fate of entire nations in their hands. They don't have armies or political office, but a single decision from them can cause financial markets to tumble and governments to fall. We're talking about sovereign credit rating agencies. Companies like Moody's, Standard & Poor's, and Fitch act as the arbiters of national creditworthiness. Their judgment, distilled into a simple letter grade like AAA or CAA, determines how much it costs a country to borrow money, whether foreign investors will fund its growth, and can even dictate its domestic policies. A sovereign credit rating is essentially a forecast of the risk that a government will default on its debts. A high rating means very low risk, while a low or junk rating signals a high chance of default. Many of the world's largest investment funds are legally forbidden from holding bonds with a junk rating, so a downgrade can trigger a catastrophic wave of forced selling. So how do these agencies decide a country's grade? Let's open the black box of one of the oldest and most powerful, Moody's, and see how the fate of nations is decided. Moody's uses a structured scorecard system built on four broad factors. The first two, economic strength and institutional strength, are combined to create an economic resiliency score, reflecting a country's ability to absorb shocks. This is then combined with the third factor, fiscal strength, to determine the government's overall financial strength. Finally, this is weighed against the fourth factor, susceptibility to event risk, to produce the final rating. It sounds complex, so let's break it down. Factor 1 is economic strength. This assesses the fundamental health of a nation's economy. Think of it like a bank looking at your personal finances. They look at the scale, wealth, and diversification of the economy. A key metric is GDP per capita, a measure of national wealth. Richer countries can simply handle problems better. The overall size and diversity of the economy are also crucial. A nation dependent on a single commodity, like oil, is far more vulnerable to price swings than a diversified economy like Germany or Japan. Moody's also analyzes growth dynamics. A country with high, stable GDP growth is like a person getting regular raises. Their existing debt becomes easier to manage over time, but the quality of that growth matters. If it's fueled by a reckless credit boom, Moody's can actually penalize the score, knowing that such booms often end in painful busts. The second factor is institutions and governance strength. This is fascinating because it tackles a key difference between a country and a company. A corporation is bound by bankruptcy law. A sovereign government, however, makes a political choice to default. This factor assesses the willingness to pay. Moody's heavily relies on the World Bank's governance indicators, looking at metrics for government effectiveness, rule of law, and control of corruption. Essentially, are the country's institutions predictable and effective? Do they have a track record of sound, transparent policymaking? Or is the government known for erratic decisions and untrustworthy data? A history of stability scores highly. The third factor is fiscal strength. This is a direct look at the government's balance sheet. Here, the most scrutinized metric is government debt as a percentage of GDP. How big is the debt pile relative to the size of the entire economy? But size isn't everything. Affordability is key. Moody's looks at what percentage of a government's revenue is spent just on interest payments. If that number is high, it leaves little room for spending on things like healthcare or education, and makes the country highly vulnerable to rising interest rates. The type of debt also matters. Debt in a foreign currency, like US dollars, is riskier because a drop in the local currency's value can make that debt explode overnight. Finally, we have the fourth factor, susceptibility to event risk. This is the what-if factor. It assesses a country's vulnerability to sudden, extreme shocks. This isn't combined with the others. Instead, a high risk in any one of these areas can pull the entire rating down. There are four sub-factors here. Political risk, like civil unrest or war. Government liquidity risk, the danger of not having cash on hand for immediate payments. Banking sector risk, because a fragile banking system can require a massive government bailout that sinks public finances. And finally, external vulnerability risk, which looks at a country's dependence on foreign capital and its exposure to global financial shocks. So, when Moody's analysts combine hard numbers on debt and growth with qualitative judgments about political stability and corruption, they produce a single letter grade. And when that grade changes, the world feels it. A change in a sovereign's rating triggers a powerful chain reaction. The most immediate impact is on borrowing costs. A downgrade signals higher risk, so investors demand higher interest rates on that country's bonds. For a government, this means more of the national budget goes to paying interest, crowding out essential services. This can create a dangerous debt spiral, where higher interest costs lead to bigger deficits, which leads to more downgrades and even higher interest costs. This pain also spreads to the private sector. The government's borrowing cost is the benchmark for the whole economy, so when it goes up, so do the costs for private companies to invest and create jobs. Ratings are also a magnet, or a barrier, for investment. A high rating is a seal of approval for global investors. A low rating is a red flag. The effect is amplified by the investment grade threshold. Once a country is downgraded to junk status, many large pension funds and institutional investors are forced to sell their bonds, creating a fire sale. This is made worse by the sovereign ceiling principle, where a private company can rarely be rated higher than the country it's based in. So a sovereign downgrade can choke off access to international capital for the entire country's corporate sector. Proponents argue this system enforces fiscal discipline, pushing politicians toward sustainable policies. But critics call it a policy straitjacket. The fear of a downgrade can force governments into austerity, slashing spending and raising taxes during a recession, the exact opposite of what many economists would advise, thereby deepening the crisis. This creates a fundamental tension. Should a government prioritize its international creditors or the welfare of its own citizens? Let's look at some real-world examples where these ratings set economies on fire. The Asian financial crisis of 1997-98 is a classic case. Before the crisis, countries like South Korea were Asian tigers with high investment-grade ratings. The agencies largely missed the vulnerabilities building up. But when the crisis hit, they began a series of dramatic downgrades. On November 28, 1997, Moody's downgraded South Korea from A1 to A3. Just 2 weeks later, it was slashed again to B2, deep into junk territory. The impact was catastrophic. The currency and stock market collapsed. International banks refused to roll over loans to Korean companies, creating a severe liquidity crisis and forcing the country to the brink of default. The ratings didn't just report on the crisis, they became an accelerator of it. A decade later, the agencies were at the center of the Eurozone debt crisis. After the Greek government revealed it had been misreporting its budget data, investor confidence shattered. Rating agencies, again accused of being late to the party, started downgrading aggressively. In June 2010, Moody's cut Greece by 4 notches, stripping it of its investment-grade status. This pushed Greek borrowing costs to unsustainable levels, locking it out of private markets and forcing it to accept bailout packages tied to crippling austerity measures. The result was an economic collapse, with GDP falling by over 25%. The downgrade spread fear to Portugal, Ireland, and Spain, threatening the entire Eurozone. This power isn't just for smaller economies. S&P and Fitch downgraded the United States from its top-tier AAA rating in 2011 and 2023 respectively. Then, in May 2025, Moody's became the last of the big three to do so, moving the U.S. from AAA to A1. Moody's cited rising government debt, large deficits, and political polarization that prevented any agreement on a sustainable fiscal path. While the U.S. dollar's status as the world's reserve currency prevented a market catastrophe, the move was a powerful warning. No economy is immune to judgment. Given this immense power, it's no surprise the agencies face a torrent of criticism. The most fundamental issue is the issuer pays business model. The government being rated is the one paying the agency for the rating. This creates an obvious conflict of interest. It can lead to rating shopping, where an issuer looks for the agency that will give it the most favorable grade, creating a potential race to the bottom on standards. This is the same conflict that led agencies to give AAA ratings to toxic mortgage-backed securities before the 2008 financial crisis. Another major charge is pro-cyclicality. The agencies are accused of being overly optimistic in good times, fueling booms, and then overly pessimistic in bad times, exacerbating crises. And when they get it spectacularly wrong, holding them accountable is nearly impossible. They often defend themselves in court by arguing their ratings are merely opinions protected by free speech. In response to the 2008 crisis, regulators in the US and Europe introduced new rules to increase oversight and transparency, but the fundamental business model remains. Now, the industry is facing new challenges. The most significant is how to integrate environmental, social, and governance, or ESG risks. Moody's now explicitly incorporates factors like climate change into its ratings. It assesses a country's physical vulnerability to climate events, like rising sea levels, and its resilience to those shocks. This is crucial, but it's also controversial. Many developing nations are most vulnerable to climate change, but have contributed least to the problem. They now face the prospect of downgrades and higher borrowing costs because of climate risk, making it harder for them to afford the very green energy projects they need. For decades, the industry has been an oligopoly. China's Dagong Global Credit Rating Agency tried to challenge the Western Big Three after the 2008 crisis, offering a different methodology. But its challenge fizzled out after it failed to get regulatory approval in the West and was hit by its own corruption scandals at home. For now, the Big Three's reign continues. Sovereign credit rating agencies like Moody's are private companies whose opinions carry the weight of public authority. Their ratings are a complex, sometimes opaque, blend of data and judgment. They undeniably shape the flow of trillions of dollars and influence government policy, for better or for worse. They are the flawed but essential cartographers of global financial risk, locked in a constant struggle to balance the interests of capital with the welfare of nations.